Hello friends, in this video we're going to be looking at understanding correlations, which is essential if you're going to be a trader to comprehend this information. We know there's thousands of intermoving parts around the world globally, all hours of every day, and to make sense of all of it and organize it and utilize that information to our advantage, this video is going to give us some tips to do so. We're going to be looking at what correlations are and how we can utilize them, the power of observation and how that is critical to recognizing these correlations, common themes in correlations seen throughout history, how day trading and swing trading can differ in this aspect, and some examples of how we have seen these correlations play out in the past. So what are correlations and how can we make use of them? There are three kinds of correlations that we want to keep an eye on: direct, indirect, and inverse. If we're looking at a direct correlation, that means if A goes up, B goes up. That's two dominoes. A hits B, B falls over. Indirect correlation is a little bit weaker, but they're still going in the same direction. And if we look at dominoes again, domino A, B, C, A hits B, direct correlation, B hits C, direct correlation between those two. A and C have an indirect correlation. A didn't touch C, but they went in the same direction based off of the movement of each other. Or I should say based off the movement of A. Inverse correlation is the opposite. So if A goes up, B is going down. Those are the three kinds that we're going to focus on. And the clearest are direct correlations and indirect correlations, and they're the most visible on the chart. In my opinion, I've only been trading for 9.5 years at this point, but in my opinion, correlations have only been strengthening with the ever-evolving change of markets relative to technology. So here, compared to 10 years ago, there's way more automated trading, high-frequency trading, bots, algos, whatever you want to call it. They're much more prevalent in this current market environment than they used to be. And that's where these bots are reading off each other and constantly reacting to each other. And that is why correlations are more important today, in my opinion, to have as a tool in our tool belt, recognizing them and utilizing them, than it was maybe 10 years ago. So how can we recognize them? Personally, for me at this point, with staring at the screen and watching these correlations for 5.5 years, pretty much every single day, I can just pull up a chart. I can know what the S&P 500 is doing on the 5-minute time frame, and I can pull up an individual stock chart and say we're correlated to the S&P 500 or not. And that just comes with a whole lot of time and a whole lot of experience. There's other ways to do it. We can have the team. We have a team at TheChartGuys where everybody in the community is all interacting and trying to help each other out with like-minded goals. And doing so, I'm not going to be able to watch all the correlations in the market, but other people are watching and focusing on other things, and they can report back and say, hey, correlation between oil and the S&P 500 just picked up significantly. We haven't seen that in a week. And then we can use that information, double check it and say, yep, I see that correlation now. That helps a lot as well. And there is a chart on TradingView where we can overlay charts and get a very distinct picture as to whether the correlation is occurring or not. And I'll show you how to do that here in just a second. Once we have these correlations identified, how can we then utilize them? So it can help dictate whether we want to be aggressive or conservative, whether we have high conviction in a trade or low conviction in a trade. I'll give plenty of examples of this in just a bit, but honestly, it helps us with confidence of the trade. If I'm looking for an oversold bounce in Tesla, this is an example we'll look at, and it's dumping, and SPY is dumping at the same time, and SPY 5-minute RSI is approaching the teens, and Tesla bounce starts to get going. I can say to myself, okay, Tesla's in an oversold bounce. The S&P 500 has not started bouncing yet, and it's due. I know that when the S&P 500 starts this 5-minute oversold bounce, it's only going to help the Tesla bounce get some further upside. I know that a bounce in the S&P 500 cannot possibly hurt a bounce in Tesla's individual stock. It can only help. So if I'm in a bounce in Tesla and entering a position and SPY has not started bouncing yet, that can give me added confidence, knowing it's almost like reinforcements will arrive and help my position see a bit more upside, because any bots in Tesla correlated to the S&P 500 haven't kicked on yet in terms of seeing some upside action. And the analogy is just a ship on the ocean. If you are in a ship and you are fighting against the current, yes, it's possible to go upriver. I guess we just shifted from the ocean to the river. It's possible to go upriver in a rowboat. It's going to be really difficult. You're going to have a much easier time going with the current, which is why we always want to have the market wind at our back, the market current at our back if we're making a trade in a certain direction. Can Netflix go up if SPY is dropping? Yes, but far more often the probability is going to be that Netflix will go down if the S&P 500 is going down. So I want to be in a trade where the market direction is at my favor. The market direction is the underlying current, and my individual trade, whatever ticker it is the boat riding that current. So the art of observation is an important skill to have as a trader. We need to observe how markets are interacting with each other. We need to observe if there's accumulation going on. We're observing the indicators. We're observing chart patterns. Constantly observing. This is a skill that I personally have been honing my entire life. I'm certainly the person that's going to be quietly sitting and observing everybody else. I love observing nature. I love observing gardening and how plants are interacting with each other and animals and the social aspect of animals. Endless observations, and that applies to markets as well. And we certainly have to be observing these correlations that are constantly shifting. They're there for half a day and then they're gone. They're there for a week and then they're gone. And we need to be recognizing when they're there and when they're strong and when they're weakening. So just like anything, it's experience, it's putting in the time. Anything with trading takes a whole bunch of time to get down, and that's what it's going to be like with these correlations as well. You're going to have to observe, spy on top of an individual chart and watch how they interact with each other for hours and hours before you get comfortable with it, and then you'll be able to recognize, I've seen this before, I have experience. That experience gives me confidence to act on this signal, or again, not necessarily taking a trade based off of a correlation, but determining how significant your position size is going to be. And again, that goes back to being whether you want to be aggressive or conservative based on what market correlations are telling us. In a recent educational video titled "What Does Priced In Mean?" that we made, we used an example of the market being a living organism with so many moving, interacting parts, constantly shifting, and that's where correlations are coming into play. So the analogy is again back to the ocean, a huge body of water that has prevailing currents that are always there. The Gulf Stream is always going up the east coast of the United States, and depending on the seasonality and the temperatures of the water and the air, it's going to dictate whether it's stronger or weaker. So that would be a comparison with a historical correlation between the S&P 500 and oil. Generally, they are directly correlated, but that correlation will strengthen. Sometimes on the 5-minute time frame, they're tick for tick doing the exact same thing. Sometimes they're doing the opposite thing. So we have to observe when each scenario is taking place. Along with that prevailing Gulf Stream, we have other little currents that are weaker, or they are short-lived and they are coming and going. And that's something that we again have to observe. Observing the ocean seems like a very daunting task, but again, having a team where you're all working towards the same goal and having experience. A ship captain 20 years into the game is going to be understanding the ocean currents way more than the person who's out on the ocean for their first month ever. So before we go any further, let's show you how on TradingView to use the compare button to look at correlations. This is SPY on the daily time frame. Let's say I want to compare oil. This button right here, compare or add. I add a symbol. And again, you could do to compare or you could do add. I do the add symbol, US oil, hit enter, it pulls up this chart, and I can double click it and turn that from a line into candles or bars or whatever I want to do. So here we go with candles. I can see, look how correlated the S&P 500 and oil were the whole way up in November and December. Look at where the correlation breaks right here. What in the world happened here? It was a news event. We had the stuff going on in the Middle East with Iran, and we had the missiles going off. And initially that was a bullish reaction to oil. And then as soon as things got the all clear in terms of not likely to see significant escalation, the market responded bullish and oil responded bearish because there was no longer a potential supply constriction on the amount of oil globally. Now we're going to go over some of the more common correlations that we see across markets with history as our guide. The first being the dollar versus commodities. In general, the dollar and commodities have an inverse relationship, meaning that when the dollar goes up, commodities generally go down. Now, out of observation, I have observed that gold and silver respond the most significantly to what the dollar is doing. Oil would fall second, and natural gas, in my observation, doesn't really have much correlation with the dollar. It's doing its own thing. So I would rank those 1, 2, 3 as far as how strong the inverse correlation is to what the dollar is doing. But you better believe that there are multiple times where I have used what the dollar is doing to make decisions based on gold. I made a gold entry a while ago, which was December 2019. And it was because gold was trading sideways. Why do I want to make a bullish entry if gold's trading sideways? Because at that point in time, the dollar was strong and the market was strong. The market and gold sometimes have an inverse correlation as well. So if both factors that could lead to a weak gold setup are not making it weak, that tells me all it takes is a little dollar weakness or a little market weakness, and that sideways gold trading can very easily start going up, and we ended up seeing that play out. In about the 8th year of my trading, I started really paying attention to QQQ and XLF and their relationship with SPY. And it was a game changer for me as far as understanding what the broader market is going to be doing in the short term. Every single trading day that I wake up and the bell rings, I am staring at what is QQQ and XLF doing, because I know if both are going up, that's when SPY is its strongest. If both are going down, that's when SPY is its weakest. And if both are going in opposite directions, that tells me the market can hold on to its uptrend that it's been in for a long time, and we're not going to see any notable weakness if one of those, even just one sector, is holding on just fine. So I know that I'm not going to go bearish the long-term uptrend of the S&P 500 unless both of those sectors are showing me weakness. We have historical companies that are strong with SPY correlation, and those are generally names that have been trading for a long time. We have institutions and market makers with significant positions in those companies. I'm talking Apple, Netflix, Facebook, Amazon. All these names that have been around for a really long time have a strong correlation with SPY. Companies that have a weaker correlation with SPY, just from observation, Tesla, CMG, Chipotle, they have a weaker correlation than the names that I just listed. We also have recent IPOs with less trading history, less automated trading, less high frequency trading going on, less established positions from market makers. They generally see less correlation with the S&P 500. The impact of fear is very significant in markets. If we're going to see a spike in fear and weakness in the markets, we generally see correlations pick up all over the place. If SPY is going down hard, we see that fear trickle from one name to the next, and everybody starts going down with the S&P 500. If the S&P 500 is really strong, generally we see most names really strong, but in my observation, the fear market is when correlations really pick up their strongest. So now we're going to look at some examples, and when I'm talking about correlations, I refer to them as either a bullish correlation or a bearish correlation. And what that means, just as an example, let's say we have Apple and SPY, where if it's a bullish correlation, every time SPY goes up a tick, Apple is going to follow it step for step on the way up. And then when SPY pulls back, Apple is going to pull back less. That keeps it positioned well to benefit from any SPY strength and not be hurt as significantly from any SPY weakness. And a bearish correlation would be the exact opposite. So here we're going to look at the S&P 500, which has been in a big time blue sky breakout daily uptrend. And we finally saw a big red day, the first major red day that we've seen in about 3 months with some notable volume behind it. So with that, anybody that's following the marijuana sector knows that for the last few months, end of 2019, start of 2020, it's been a bearish correlation with the market. The market has been running really hard. It has helped the sector, but it hasn't helped it significantly. It's almost like every 2 steps that SPY takes forward, the MJ sector takes 1 step forward with it. And then when SPY takes 1 step back, the sector takes that same 1 step back, keeping it less favorable. So let's just look at the example. Here's CGC, the 5-minute time frame on this chart with SPY. So SPY pulled back 1% this day, and CGC went tick for tick with it, but this pullback on CGC is more like 6 or 7%. That's a very bearish correlation. And let's go back 2 days ago. 2 days prior to this, what's the correlation look like? Well, we have the S&P 500 starting with some green, little pullback, new high of the day. At the same time, CGC dumps at the open, lower high and lower low. It's going in the exact opposite direction. So it is not benefiting from SPY strength, and it is certainly hurting from SPY weakness. That is a bearish correlation. Here's an example of a bullish correlation, Tesla and SPY. So Tesla, this is the 1-minute time frame from January 23rd to start the morning. We start with a little bit of a pullback. Tesla hits its low of the day at 9:38 and then rockets to a new high of the day. Big bull move there. Low of the day, 9:38. What was SPY doing at that same point in time? It was pulling back. Look where it hit the low of the day. Low of the day was right on the dot, 9:38. Right there, built a little base of support. Look at this 4-minute bounce. This 4-minute bounce on SPY was enough for the Tesla bulls to make their bottom and bounce as well. SPY then saw a little bit of a pullback from that little bounce. Tesla did as well, but it was only a little bull flag. And then the bulls said, here we go, and just rocket shipped with bull volume straight through resistances. That is a bullish correlation. The low of the day was marked by SPY, but it favored the bounce way more significantly. There are many times where I'm watching an individual name, and if SPY is pulling back into oversold conditions, I can clearly say, yes, it's worth watching for bounces on individual names, but they're likely not going to get started until the S&P 500 finds a bottom. From there, names that are favored with bullish correlations will bounce more than SPY, and names that are less favorable with bearish correlations will bounce less than SPY. This is a little cheat sheet template I made to try and help visualize things and keep them a little bit more simple. So if we're looking at QQQ and XLF, they correlate directly to SPY. If they are going up, SPY is going up, and vice versa. DXY, the dollar, correlates to commodities inversely. If the dollar is going up in general, most specifically with gold and silver, they are generally going down. Gold and SPY, that correlation varies, and I'll show you an example of what led to a break in that correlation, and it was a technical break on gold, a long-term pattern breaking bullish, which led to an influx of volume and traders, which broke that correlation. So SPY and oil, direct correlation, going in unison. An individual name with increased volume, whether it's from earnings, from analyst upgrades or downgrades, or from individual news to that company, that's going to lead to a break in the SPY and market correlation. So if Netflix has earnings and they are bearish and SPY goes up 1%, Netflix is still going to have a bearish reaction. Maybe it won't be as bad, but it can still go down because the market is pricing in that fundamental event. Same thing with an upgrade or a downgrade. It can go opposite of the market or individual news. That's when volume is marked by that fundamental event. It leads to an influx in volume, and that volume throws off the bots that are correlating things. If volume is low and we're not seeing an influx of unusual volume or a lot of traders jumping on a name, that's when the high frequency bots have more visual control of things because there's less outside volume. They have a significant stake of the percentage of the volume that's being traded on any given day. Market bear volume increase. Individual names correlation to SPY strengthens. That's that fear narrative. When there is fear in the air, correlations pick up to the downside. Evolving sectors and markets slowly enter the correlation scene. So back when the MJ sector was just starting to see its names upgraded to listing in the US and then listing on the NASDAQ and the NYSE, we started to see some correlations, and I was able to observe them really early on from my experience or observing correlations in markets. And I remember there was a lot of pushback initially. There was a whole bunch of people that were saying, we're not correlated to the S&P 500. You're wrong. This isn't happening. Now, a whole bunch of months and years later, the market has developed and matured more. And now it's very generally accepted that there's correlation going on with the S&P 500. Again, the market makers establish their positions. The bots, algos, and high frequency traders all get their tentacles in on an individual name and latch on, and then that's when we see those correlations strengthen. Bitcoin is another example with fluctuating correlations. I have been watching Bitcoin for 2.5 years looking for geopolitical or global economic correlations. I've seen it twice for very short periods of time, the most recent being this Middle East and Iran debacle. I noticed correlation between what gold was doing, what oil and markets were doing, and what Bitcoin was doing. And it lasted for about 3 to 5 days. So that tells me, pay attention. I personally took one trade on Bitcoin during that time frame, specifically based on a news headline and knowing how the market would react to that news headline. Normally, I don't do that in the cryptocurrency space, but I saw enough of a correlation that allowed me to do so, or I should say it led to me to do so. And it was a profitable trade. Obviously, one example is not enough for me to say, yes, for sure, we're seeing that correlation. But again, noticing the early signs of correlation as markets develop is important, and we can take advantage of that. So here's an example of gold and SPY on the monthly time frame. And we have gold right here, and we have SPY above it. So look at the inverse correlation. Here is SPY with 5 green months in a row. Here is gold with 5 red months in a row. SPY then pulls back for 2 months, 3 months. And gold goes up for 3 months. We then see the market recover for 3 or 4 months, while gold pulls back for 3 or 4 months. Inversely correlated for pretty much March of 2018 through June of 2019, over 1 year of inverse correlation. Then it changed. What changed? We had gold. You know we love equilibriums here at the Chart Guys. So gold was in a long-term equilibrium with our low, high, higher low, lower high, higher low, lower high, higher low. 2-year tightening range. It broke bullish. The bull break took place here in June of 2019, and it was triggered in part by a big red month in the S&P 500. From there, the S&P 500 had 2 green months in a row, full recovery, all-time high. At that same point in time, gold had 2 green months in a row. Why did that correlation change? Because a 2-month-long equilibrium broke bullish, and traders like myself who had not traded gold really at any point in the last year plus, I entered bullish on gold on this bull break because it was a long-term pattern we had been watching. So that alone, that long-term technical pattern breaking, seeing an influx of traders, algos, and bots flock to it for the volatility spike and the volume spike that are associated with those equilibrium breaks, it broke the inverse correlation with the S&P 500 and allowed both gold and SPY to go up at the same time. So this information can definitely be utilized for both day trading and swing trading, but in my opinion, it's more essential for day trading, just in the sense that your sample size is so small. If you're looking in 1 day, these correlations can fluctuate pretty significantly in that 1 day of time. If you're looking weeks and months out, that correlation fluctuation is going to be tempered a little bit and it's going to be smoother. It's less significant. I certainly still want the market to be going in the same direction as any swing trade that I'm in, but it's not as pertinent information, and you don't have to be watching tick for tick, of course, as to what these interactions are looking like. So one more reminder, how does volume and volatility come into play? When an individual name sees a spike in volume, whether it's fundamental reasons or whether it's a technical reason, a clear pattern breaking that a lot of people are reacting to, that's when we break correlations with the broader market. When we see market volume spike, most notably when it's fear-based and to the downside, we see correlation strengthen and the entire market generally goes down with it. That's why we see stairs up, elevator down, with everything dropping fast in unison, because fear is a very powerful emotion and things link up on that fear. So I appreciate you watching. Feel free to ask any questions, likes, subscribe, comments, all of that. I'll check the questions here and respond as I can. I know it's a tricky topic to try and hammer down. Feel free to join ChartGuys.com and our community where we're talking about correlations all the time, specifically while I'm live streaming. And I hope you have a good rest of your weekend. Appreciate you watching.